Thank you, everybody. Good afternoon, good evening for those on the West Coast. Thank you for joining us today for our Bonding 101 seminar. Hope everyone had a hope everyone had a good weekend. Got to relax, and thank you for joining us today.
Thank you.
We're gonna go over some no problem. We're gonna go over some housekeeping rules. If you have any questions, feel free to either I know raise your hand feature or put your questions in the chat box. I will be monitoring the chat box for Jennifer, who will be presenting today. So if you have any questions, feel free to put it in there. Camera, you can have them on. If you'd like to be more engaging, and please try to keep your microphone on mute throughout the session, so we could keep the meeting going. And please be an active participant. Please make sure you change your names and, like Jennifer said earlier, put your name and what type of construction are you in and what you do in the chat box. And without further ado, I'm going to introduce Jennifer.
Hi, hello.
Hi. My name is Jennifer Elmore. I am with the Meriwether and Williams, a hub company, and I'm very excited today. It looks like there's a really good mix of general contractors and subcontractors, and so I'll try to, as well as support services for construction companies. So I will try to address everyone. If I start to echo, I will turn my camera off because my bandwidth on my camera is usually not enough. I do like to make it as interactive as possible, and I know with a group and on Zoom, we can't do that as much as I would like. So what I'm going to ask you to do is I will periodically turn to Jason and ask him to read your questions in the chat to make sure they're addressed. If I speak too quickly, let me know. Everybody gets nervous, or most of us get nervous while speaking. And so I may speed up, but I want to make sure you guys get all the information you need. My background, just to let you know, is I'm a fully licensed broker. I, work with various construction as well as other type of companies to provide them bonding. We'll go into what that means later, but we'll start now with the basics of Bonding 101. And Jason, if you could, next slide, please. Okay, so why do you need bonds? They're mandated by law. So the reasoning behind that is, bonding goes back, or the type of guarantee we're talking about goes all the way back to the Bible. But for our references here, this is something that happens because, and it came out of the Tennessee Valley Authority during the Great Depression. A lot of construction companies would start projects and then they would lose the taxpayer dollars and fold. And so this is a way to protect on public works projects the taxpayer dollars. So they are mandated by law. At the federal level, and I'm sure this is not as interesting, it's called the Hurd Act from 1894 and the Miller Act, and it requires performance and payment bonds for public works projects over 100,000. And if we're to be technical, it only requires payment bonds. So when this was implemented back in 1935 with the Miller Act, it then went to the states, and all of the states started implementing what we call Little Miller Acts, and it varies by state, but it's usually, and I'm just generalizing here, it's usually for payment bonds for projects $25,000 or more. You should check how your entity does it, or the public works entity that you're bidding on does it. There are some bonds that are construction bonds for public work projects, also for P3 projects or public-private partnerships that can be required, and developers often ask for bonding as well. Once again, it's a way to protect the project and to make sure it continues. Next slide, please. And Jason, remind me if there's any questions between each slide.
Will do. Thank you.
No, thank you. Okay. So why do I need a surety bond? So the bond, as I said, protects the owner, and it'll make sure that the project is finished at the negotiated price. And this is, if you're a general contractor, it's the bid price. If you are a subcontractor, it's the negotiated price, and this is according to the plan specifications and contract requirement. This is also insures to the owner of the project, and this could be a private developer or the public, is that it is your subcontractors, your suppliers and vendors are paid for their services, and that the project is turned over to the public works lien free, or in the case of public works, it's actually stop notice free. And liens are on private projects, stop notices are on public works projects. And so the bond acts as a pre-qualification instrument and for the contractor's ability, for the letting the contractor's ability and the owner know whether they can pay for the project and complete the project. So sureties will ask for information to do their due diligence to see if you've done projects of the same or the like in the past about the same size to make sure that they can extend you the bonding. And we will get into how you apply for bonding later. Next slide. Oh, any questions? Next slide, please.
You're good.
So what is a surety bond? It is a three-party agreement that obviously guarantees the completion of the contract. You have three parties. One of them is the contractor, and in your bond forms, you will see it as principal. And we're only making sure you have it so you recognize the language when you see it. The owner is called the obligee. The surety, and you will see it too, is the obligor. So those are the three parties that are entering into the project. Now, what the sureties, what they're actually doing is they're guaranteeing to the project owner or the obligee that the principal, the contractor, is qualified, will perform the contract and pay all the subs and suppliers and the laborers as required by the contract. Any questions? Next slide, please. Okay. So as a three-party agreement, it protects another party. So this is one of the reasons why it differs from insurance. You cannot simply buy it like insurance. And insurance is just a standard risk transfer mechanism. So it's transferring from a group of people that are lumped together to another. So when you buy car insurance, everyone of your like kind is lumped together with actuarial tables, and then they determine what kind of risk it is. Whereas with surety, you must qualify for it. It is more like a bank line of credit, and it's the surety is viewing that they're lending you the money or the amount of the project for the duration of the project. So unlike insurance, when surety underwrites, they expect you to succeed. They expect no losses. So how do they make sure, more like a bank, that you'll finish the project? What they're going to do is they're guaranteeing to the owner, but from the contractor, sub or prime, they're going to ask for an indemnification.
Yeah, I would like to set up a.
So an indemnification just essentially says that if there is failure on the project, that you will make them whole. So we have here a triangle of the relationship saying the surety, if there's a default, this is only if there's a default. The surety pays the owner for the damages through the vehicle or the mechanism of the bond, but this is only when the contractor fails to perform, and then the contractor will reimburse the surety for the payment to the owner. Now, once again, I want to just reemphasize, when you're qualifying for it, the surety is saying to you as well that we think you can do this. They don't want to pay out damages. Their whole model of business is that you will not fail. And so that's just one of the things that I just want you to take into account. So any questions? And next slide, please, if there's no questions. Okay. So one of the things that's really important is surety bonds are in construction are referred to as contract or project surety bonds or performance and payment bonds. And this is distinct and separate from any licensure bonds or license and permit bonds that you may get through your state. And not every state has them, but they are, the license bonds protects your professional code, whereas, for example, the contract bonds or surety bonds are project specific. So we're going to get to, we're going to get to the what is needed to qualify for a bond approval. That's coming up. You're jumping ahead, and that's a good thought. So a bid bond is essentially when you're bidding on a project, owners will ask general contractors for a bid bond. And the bid bond is when you enter into the contract, and the bid bond is the pre-qualification phase for the surety company. This is where they're looking at the bid bond as if you had won the project. And so the bid bond states that the surety believes that you are qualified, that you have the ability to do the project and pay the subs and suppliers. And what they will do, and it's an assurance to the owner and to the contractor that they will issue the performance and payment bond if you are awarded to the contract. So the one thing we want to highlight, and I haven't ever seen it in my 20 or so years of working within the surety industry, but it could happen if you refuse to enter into the contract and you are the low bidder, then the surety is responsible for the price between your low bid and the next bid as a potential. So I just wanted that known. The performance bond guarantees that you will complete the project as specified by the project. The payment bond says that you will pay all the sub-suppliers, laborers, and it will be free of liens or unpaid suppliers, free of stop notices, and then maintenance bond. So within a performance and payment bond is a 1-year maintenance period that is covered by the surety company. Anything that goes beyond that 1-year period, sometimes you will see 2, sometimes 3-year period, either the surety will charge you extra premium or the owner will ask for a maintenance period. Now, usually maintenance period bonds are asked for roofers or swimming pools or something where things need more maintenance. And so there's a separate charge. A completion bond is usually not, I have not seen one, but it is for high risk performance bonds where there's a specific performance. And if I were to think of a scenario for a completion bond, it's, for example, if someone is creating a computer program where it needs to do something very specific and you're paying for the performance and it is very unique. So if you can't complete it, they need to offset their costs. Okay, Jason, any questions?
Yes, we have, what is a license bond?
Okay, so we're going a little bit off topic and that's great. A license bond is a bond that covers a profession that is run by the state. So usually license and permit bonds are bonds such as notary bonds. If you get your notary license, some states require a contractor's bond. So for example, for me to be an insurance agent, I need to, or a surety agent, I need to have a license bond that I follow the profession code of my profession. And so not everyone is required to do that. And when you get your contractor's license, they will tell you in your state right away, and they will have lists, and many people will contact you to make sure that you get your license. And it's usually a bond of $25,000 or less. Does that answer your question? Okay, next slide. Okay, so what do surety professionals analyze? There are the 3 C's. Yes, it is issued by the surety company. Usually with surety companies, you don't go directly to them, you go through surety brokers. And what surety professionals analyze, and this is with surety company, is they analyze your credit capacity and character. And this includes personal and professional. So when you go to a surety broker, they're going to gather all of your documents, and it's always best to pre-qualify, and we'll get into that more in depth. And they're going to ask for annual and interim statements. They're going to ask, and the list we have here is if you were to do everything by the book perfectly. This is a list that if you cannot do everything on this list, then that's not required. But this is just if you had everything perfectly, this is what would be required. They're going to look at your banking relationships, how much working capital you have. A rule of thumb with surety is usually, and generalized, it's for every project you have 10% working capital set aside to fund that project, because usually public work projects are delayed and the payment mechanism is 45 to 90 days. Now, we do have within Meriwether and Williams and our programs relationships with contract-based financing professionals. And we have people on our staff that you can contact. You can contact me or anyone else after this project to find out more about that. We also ask for a work in hand schedule, your capacity. What they're looking at is your ability to perform, how you've done on other projects, your past and current and future workload. And that's usually, and we'll look at the forms that they look at. They look at a continuity plan. So let's say you've been in business 10 years. What happens if something happens to you? Who is going to finish the project? They look at your organization, your management plan. Do you have sufficient equipment? Do you have enough personnel? Do you have enough people in your staff? There's kind of a general rule of thumb that for every 5 personnel in the field, you will have 1 person in the office supporting them. And so they're kind of going to look at your organization to see how well you're functioning. With your character, they're going to look at not just your business, but they're going to look at project owners. There are some project owners that are known to be problematic to work with. And surety is a small business and they all talk to each other. They're going to look at your subcontractors. Do you have a long relationship with them? If you're a general contractor, you as a subcontractor, do you have a long relationship with your general? They're going to look at your vendor and supplier relationships. Do you have a banking relationship? So they're going to look at all those things. Now, one of the things I want to emphasize is the surety company does not want to say no, because when you succeed, they succeed because they make money out of you doing your business. And so one of the things is, but they also don't want to say yes because they don't want to put you in harm's way. There may be something to do with the project that they think may put you in harm's way. So just keep that in mind. And I saw there was a question, Jason.
Yes, we have 2 questions. Going back to the license bond,
Okay.
is this also issued by the surety company?
Yes, it is also license bond is also issued by the surety company.
Thank you. And the second question is, what happens if you do not get approved?
Okay, so one of the reasons Meriwether and Williams exists is because it is a passion for all of the people on here who work for Meriwether and Williams, and myself personally, is that we work to offset potential issues that you might have in getting bonding. So, for example, throughout our various contractor development programs, work with contractors to make sure we can offset any issues and barriers and help you surmount those. So just be prepared, and we'll go into that a little bit further. But I just wanted to also say, surety will do a credit pull, but it is a soft pull, so it doesn't impact your credit score. Next slide, please. Okay. So how do bonds work? This is the first step in learning, is first you get a surety broker. Now, surety brokers are different than insurance brokers. Insurance brokers know about insurance and surety brokers know about bonding. And that is so simplified, but it's true. You want to find a broker who is close in your region. because if you need a bond tomorrow and you've already pre-qualified, you want to make sure that they could drive it over to your business to get it to you if necessary. So, and you want someone who has sufficient markets. So what does that broker do? What does that surety broker do? First, they gather the documentation, which we will review later on in the next half of this. The broker then sends your submission after talking to you about what are your goals. They'll submit you to the surety market for underwriting. Yes, the slides will be shared after class. Okay, sorry. What we would do in terms of is the next step would be obtain a letter of bondability. You can also call it a pre-qual letter. And so if there are subcontractors here that are working with large primes that are asking them to pre-qualification, this is a good reason to start this process now. So the next step would then be to identify a bidding opportunity. If you are a prime, if you are a sub, identify a prime that you can bid to on a public works project that includes your scope that you're comfortable with. The next step would be for the generals to request a bid bond from the broker, and you submit the bid bond along with your bid estimate to the owner, and then the bid results are received. Now, in the best case scenario, you are low. At that point, you turn around, send the information when you get your NTP or notice to proceed. You request the final payment and performance bond from the broker for this job. And then they submit, the broker will issue on behalf of the surety, the performance and payment bond, and then you'll start work. So that's kind of the chain in which it will go. And we want to emphasize that you should come to us now to get this started right away. Next step. Any questions? The next slide, please. Okay. So bid bonds, standard surety practice, bid bonds are free of charge. There are some exceptions, and it is something called $50 to maybe $200 a year. It's called a bid bond undertaking. And that's when you have a lot of bonds, bid bonds that you do in a year. And so they'll charge maybe $50 to $200 for the full year. Now, performance bonds run from 1/2 to 3%, and it is a filed rate with states, with their insurance departments. So the rates are based on the risk of your business and where you fall into. So, but they're staggered rates. So the first $100,000 is 3%. And this is not set in stone. This is generalized, and then it will go smaller as the project gets larger. So a $5 million project will have various rates at various stages. So one of the things I just want people to keep also in mind is that it is important to know your rate so that you can include that in your bid when you bid on projects, and include it in your estimates to pass that on to the owner and or general contractor. The payment bond, the price is included with a performance bond, so it's not going to have a price to it. Any questions? And if not, next slide.
Yes, we have a question. Will the lowest bidder always get the project?
99.9% of the time, yes. There are some exceptions, as there usually are, and some of those exceptions are that you made a mistake in your bid. When you when a bid spread is over 200% difference, you should probably go through your numbers and figure out what you did and what you missed. So if the bid spread with the numbers are within reason, if it is a public works project, they have to usually take the lowest bid unless there's issues with it. And if you have further questions, I'll stay on after, and then we'll let you speak and you can ask me more questions. Next question, next slide, please, or next question. Okay, so one of the things before I go on to the next section is I want to emphasize that Meriwether and Williams has programs that can assist contractors in getting bonding. And so we ourselves don't act as brokers, but we can refer you to brokers with whom work with the program. And we like to see you come in as early as possible to make sure that you know and feel comfortable. And if you have any, should you have any deficits, we can make sure that you are taken care of and that we can reduce those barriers to bonding. Jason, any questions?
Yes, we have two questions. First one is, at what point will the bond issuer require a third party to review financials of the general contractor?
Oh, that's a really, really good question. So essentially, when you first get started and, this is the difference between a good broker and an insurance agent. They will ask you questions about your bonding needs. So if you are new to the business and you're starting out with projects in 200 to 300 to maybe $500,000 range, then you really, really do not need CPA prepared financial statements. And and so as you grow, which is what we'd like to see you do, as you grow, then you're going to start needing compilation, which is the lowest level of CPA, and then review quality statements. But that's usually around the $1.5 million annual volume mark when you can afford them. So one of the things that I've noticed in helping contractors do the pre-qualification process with primes is they always ask for review quality statements, but that is kind of the gold standard that you don't need to do when your business isn't there yet. There are ways to complete those pre-qualification and provide them the information they need without you having to spend $7,000 to $12,000 getting review quality statements. I hope that answered your question. Jason, I saw another question come in.
Yes, second question, does having a WBE or DBE cert help in any way when the bonding company is reviewing the application?
So it doesn't, but there are the WBE, DBE, MBE, LBE, SLEB, or SBE certifications also can give you access to various bonding assistance programs, whether it be through Merriweather and Williams, which are no fee is charged for us, or through the SBA. There are various programs out there that can help you to get where you need to go. And so we just want to make sure that you've got that information. Any other questions, Jason?
Yes, one last one. Does your company charge for the bonding assistance process?
We do not charge for the bonding assistance process. We are sponsor, so our program sponsors. So this is whether you are in Bexar County, in Charlotte, in Los Angeles, or San Francisco, or any other location, Alameda. The sponsors are the one that want to see more local businesses thrive. And the idea of having local businesses thrive is you hire local people and the business tax dollars stay there. So it's healthier for the community as well as the businesses. So this is their way of giving back, where they recognize that sometimes doing business in their areas or geographic areas can be a little bit more expensive. Any other questions, Jason?
That is it for now. Thank you.
Okay. I see one that just came
Just
in.
kidding. Yes. Can I qualify if I'm starting my company? I'm a small company, but I've been in the field for 20 years.
Absolutely. So one of the things is, and we're going to go into this more, is when you first start out and you've been in the field for 20 years, we will then focus with the surety to get you to show your experience through a resume. That is one way we can offset the fact that you do not have the financial track record. So I'm going to go into the paperwork that you need now, and I'll go into that more in depth. And once again, you can ask me questions and I'll make sure to answer anything that you have. Next slide, please, Jason, unless there's a question. Okay. So why is it important? So we'll cover the documents and the timing of the issue. Next slide, please. Okay. So one of the things is having your documents in order will give you an enormous advantage when applying for surety bonds. Now, that's the gold standard, and we will help you try to get to the gold standard if you're not there. If you've been in the field, but you don't have your documents together, we will work with you to get your documents together. Um, you know, it can also, if you have all your documents together, just like anything, it can expedite the process. Surety likes to have 2 weeks to review your business and review all your documents. And if you piecemeal them, it takes longer because they pick it up and then they put it down. And somebody who submits a full package kind of leapfrogs ahead of you. So we like to have we work with your broker to have all your paperwork together before you move on to the next story, the next chapter. So what's really important too is that when you hand in your paperwork, when you first start out, you don't meet the surety. Your paperwork itself tells a story. So one of the things I do, even though I don't place the bonds, is that I will go through your paperwork and make sure your story is complete. Work with you to make sure that your information is all there. You know, if there's something, for example, you've been in the field for 20 years and you are extremely knowledgeable, let's beef up your resume so that people know how much experience you're bringing to the table. Questions? And if no, next slide. Okay. So the surety starts off with an application or questionnaire. The surety questionnaire is what it's called. Jason, can we take a look at it?
Yes, give me 1 second.
Yes. So I just wanted to, so these are our forms that we've made generic. There are other forms, but they are in essence the same. And, you know, sureties or brokers don't quibble. It's the information that's important. And this, okay, can we go to the application?
Oh. Second.
There we go. So this is a program application, and if you go through it, it's going to ask general information that most people do not have a problem answering. It's just kind of a cheat sheet that gives the surety an overview of who you are, what your operations are. Can you go down, Jason? So some of the things they're really looking at is your scope of operations and your territory. They want to see what regions you're in. Are you spread too thin? Are you concentrated in one area? Are you overextending yourself? They want to see how much you work as a prime or a sub. None of these are negatives or positives. This is just trying to figure out this information. How much of your job is sublet, how much materials? Do you require bonds of your subcontractors if you're a general? So next page, please. So then they're going to look at your history. Do you have a history with a surety agent? Or are you going for a new relationship or have you had a long past relationship? Then they're going to ask the questions. If you answer no on any of those questions, or yes on any of those questions, sorry, what we're going to do is we're going to work with you to write a letter of explanation to make sure that you can explain why there might have been a loss, what was the resolution, why were you denied credit, and then at least let them know. Then one of the things that's really important that we would ask for is resumes, but we'll go on down. Sorry, Jason. Then they're going to ask your relationships with financial institutions. They're going to ask about your accounting and financial reporting. And one of the things is knowing the information on this, whether and some people may know this, construction has specialized accounting and it's accrual, but we'd really like to see percentage of completion so that we see where you are in the project. And so what we will do is we'll work with you that you understand what all these questions are and what's important about it. Next page, and then I'll get to the questions. So then they're going to ask for your experience, and sureties are conservative in nature. They're going to look at your largest job, and they are going to call these people and, that you work with to get references. They want to make sure that you were profitable, and they don't like to take huge jumps. So if you did a project for 200,000, they don't want to jump to 2 million. So that's one of the things that we're going to try to work with you to understand this. Jason, questions?
Yes. First question, if you have been denied bonding previously, does it hurt when you apply again?
So, oh God, I always answer the same question. It depends. So were you denied bonding because of personal credit, or were you denied bonding because you were asking for a $4 million job right out of the gate? So there are reasons you could be denied, or was there a complexity in the project? Okay, so one of the things we can work with someone on is cleaning up your personal credit. We have resources we can refer you to that work on that, and usually they're at a minimal or a low cost. If it's because your project was too complex or too large, then no, that's not going to hurt you. And even if it was personal credit, that's not going to hurt you either. It's just a impetus for us to start working on your credit and getting it where we need it to be. And if I remember, the next slide would be, the next form is the cost breakdown, or is it?
The bond request form. I still have
Bond, yes, let's do the bond request form, unless there's more questions.
Yeah, I got 2 more questions for you.
Perfect.
If a bank rep to a general contractor were to downgrade the relationship to a special asset group based on previously liquidated gaps, how does this affect bonding?
So, okay, let me make sure I understood the question correctly. You went bankrupt and you're reforming your company. Is this true or not? Okay. So if you had a bankruptcy, it's going to depend on why, and it's something we'd have to explain in a letter to the surety. It will impact your credit, and it will impact your surety credit. So it's something we'd have to look at individually to make sure that we understand it and we give the correct answer. So I'm going to give my number at the end of this, and you can call me and we can take this offline. Is that okay? Okay, perfect. All right.
Thank you. Next
Question,
question.
Jason.
Will new company information be based on credit on personal financial statements / credit?
Okay, so the surety is what they call a blended. And it is on personal credit, it is on company credit, and it's on, they do kind of a LexisNexis search to see if you have any court cases or anything that come up. And then they create a number, their own personal, each one has their own personal score. Being new in business is not as detrimental as long as we have certain things in place and that we're actually bolstering your resume, showing how much experience you have, showing that you've worked for other companies, showing what you know and are knowledgeable in the business. They're not going to give you $2 million out of the gate, but depending on your credit, business and personal, we may be able to get you some, and we'd have to do that on a personal basis. So it's individual. So we can be able to look at that. And once again, I'll give out my number in the end. Okay, next.
That is all the questions we have for now.
Okay, so let's go to the one, that one. Yes, contract. Okay. So this form is not only is sent when you have a specific project, and it goes over the project. And once again, you are the principal. You are requesting a bid bond and or a final bond. As you can see, it goes bid, final, new, existing. What it wants is information on the project, whether it's an owner or, they also want to know the prime contractor if you're a general. One of the things that I really want to show here is down at the bottom when it says contract requirement, the terms of the contract are kind of how long it's going to be. the essential, the start date and the completion date. So they want to know how the performance bond is usually 100%. Maintenance bond, we went over that. That's if it exists, and it oftentimes doesn't. They want to know the retainage. Is it 5 and or 10%? Now, this is really, you can do most of this and get most of this information on a search in your documents, your project specs and manual. You can go into, they're called liquidated damages or LDs, and they're a per diem. They are set by the contract, and they run from, depending on the contract, they are set by the owner. And liquidated damages are not meant to be a penalty, but they sometimes can be a penalty if they're set too high. So the surety wants to see those, and they may deny a project because of the liquidated damages. And I'll go into that. And then the length of the warranty, how long the warranty is. So is it a year? Is it 2 years? Is it 3 years? And they will charge more if it's 2 to 3 year warranty. Now, back to liquidated damages. One of the things I want you to be cognizant of is that if you are a sub entering into a prime contract, the prime in their subcontract agreements and documents will have something called an incorporated by reference, or, they will include the general conditions of the owner into your contract. And the liquidated damages of the owner could potentially be passed down to the subcontractor. So I've seen it where you're a painting contractor with a $500,000 contract on a $65 million contract, and they're passing down $10,000 a day damages through liquidated damages. And that's one of the things we just want you to be aware of. And so you can do your own search via Adobe, and you can see what they are. And you can look under liquidated or under LD, and it'll show up. It's nice when they're not there. So, but this is a form that you submit when you have a project specific, and these are and every broker has their own, or every surety has their own. We just wanted you to be aware of it. The next one would be the cost breakdown. There. Okay. So the cost breakdown is pretty much what you've seen. It's just your estimate. The only difference that I've seen that we've put into our form, because we want to obviously bring it to your attention, is we want you to know the price of your bonding. We want you always to include that. I'm using simple numbers because math off the top of my head is not my forte. But let's say you have equated a 10% profit into this project, but you forgot to include the bonding in your estimate, and the owner then says, no, we're not going to pay for it. You should have included it in your project. So one of the things is if your bonding is a 2% rate, you've already have profit fade from 10 to 8% immediately without even starting the project. So we want to make sure that you're cognizant, and that's why we include it on our forms, because it is a direct cost of the project, and we want to make sure that you're aware of that and include that in your costs when you're bidding to projects. Jason, I don't know which one's next on the list. Oh, any questions? I'm sorry. Okay, so I'll do okay. All right, so this is the contract work in progress. Can you make that larger, please? So right now it's an Excel spreadsheet. It does have formulas in there, but this is just, you put the numbers in there. This is just so that they know where you are on each project. And and it shows, because it shows original cost, change orders, as well as it shows whether you are maintaining the profit that you estimated. So you would do this for every project that you're doing. Now, there are some exceptions. There are some types of construction where you have some smaller projects that are maintenance type projects. Those would not go into this type. Those would just be listed to make it simpler for yourself. But this is a form that we have training seminars on to teach you how to do. If that's something that you'd like, make sure when you're filling out the evaluation form that you include that in there so that we do a contract in progress analysis seminar and a cash flow seminar. I think those are really helpful to support businesses in what they're doing. Next, unless there's questions. Jason?
Sorry, next we have COI. One
Oh,
second.
yay. Thank you. So COI is Certificate of Insurance, and it kind of looks like a contract in progress analysis, but it'll change in a second. There we go. So a COI, well, this is just a standard form. Now, one of the things is each project will be different. This is just a generalized form with general liability, and this is just a check mark to show you. Can you go down, Jason? And so here it shows, the named insured and how it's going to be, but each project will have its own and they will have individual limits and requirements for it. And so just make sure you give your insurance documents for the project to your insurance agent for them to do the best to help you. Next slide. Or next form.
And lastly, we have the personal financial statements.
Okay. There we go.
Oh,
So a personal financial statement is pretty standard. This is just our form, but you submit these to banks, you submit these for various reasons. Usually the rule of thumb is that for sureties, it's anyone who owns 15% or more of the business, 10 to 15% or more of the business. Each person will have to do it and sign off on it. They don't require necessarily your form or their form as long as the form you're using is within 6 months. This is just personal. And that would be it, unless there's questions.
No questions so far.
Good. Thank you. And then we'll go back to the rest of the documents that are required in the presentation, and then you'll almost have your evening back in a second. Okay. So what else you need is, and this goes back to the business financial statements, it goes over your balance sheet, your income statement. Now, there was a question earlier about CPA prepared. That is not necessarily a requirement. I mean, obviously it is absolutely, at a certain point in time necessary, but when you're first starting out, having interim statements is great, whether that be QuickBooks or some kind of other American contractor or other kind of program. We don't endorse one over the other. That's a personal business decision you've got to make. But first starting out, QuickBooks is perfectly fine and understandable as long as it is on the accrual method and not the cash. They would also like to see if you have an aging schedule, and for aging schedule, what that is, it's the accounts receivable, accounts payable. What they're actually looking at is how quickly you get paid and how quickly you pay your suppliers and vendors. And that goes to, once again, it goes to your character. So it's beyond just looking at your personal financial statement or your credit score. There's more to it and it's more complex. They also like to look at 3 months bank statements. They kind of want to see how your cash flows. So back to the business financial statements, if possible, they would like to see 3 years because they're tracking a trend. Then they look at if you do not have business financial statements or interim statements. Some sureties, and these are fewer and far between, will look at your business tax returns. Because there is a balance sheet and an income statement on your tax returns. But usually when your business is dealing with tax returns, you will be in a higher, you will be classified in a higher risk category, and you'll be more at the 3% rather than less. Next slide, please. Oh, questions, sorry.
Yes, we have one quick question. For those financial statements, if there are partners in the business, does everyone have to submit the personal statements?
Yes, so it depends on your state. No, it doesn't depend on your state. So in California, I can say, because it's a community property state, husbands and wives are required to submit their personal financial statements. Other states might do it differently, but usually it is not just anyone owning 10% of the business or more, but also their spouses. And once again, I just want to remind everybody that sureties underwrite for no losses. And so the risk you're taking on signing these is that you are risking is less because of the surety's due diligence. And you trust yourself and your business, and you've been in business for I don't know how long, but if you've been running it successfully for 1 year, 2 years, 3 years, 4 years, 5 years, then you can trust yourself to continue doing that. Next slide, please. If there's next slide. Okay. So, you know, and we go back to talking about if you're new in business or if some of your information isn't as strong as you'd like to see it, then your resume is of key personnel. And these are people who aren't even owners. These are people who have a lot of experience that can make your business look good. We no longer ask for reference letters because people have a tendency not to give those anymore, but we ask for a reference list that the surety will call up with emails and phone numbers. If you are incorporated, we ask for copies of your articles of incorporation. If you're a partnership, we ask for the partnership agreement here. And if it is true, we ask for a copy of the family trust. Now, the last thing is the surety will give you an indemnity agreement to sign, and that was that indemnification we discussed before. And I know I'm going quickly, so you probably don't remember it, but the indemnity says that if you have a loss, you will make the surety whole. And so the indemnity agreement is the surety security against loss or damages. Next slide, please. So why is timing important? It's not just the enormous advantage when applying for bonds, but it's also knowing in advance of what you can do, how to improve your bonding if you need that. It's also knowing what your premium rate is so that you can include that in your bid. It also shows a level of it also makes if you're working with primes and you know you're a sub, you can tell them, here is my bondability letter and I've already been pre-qualified. And so they're more likely to look at someone who has been pre-qualified because they know that you have all your paperwork in order. Any questions?
There are no questions currently.
Perfect. Next slide, please. Okay. Obviously, we have a Q&A. If there are no questions, I just want to thank everyone for attending today.